Hey, strategic investors, welcome back to the Strategic Investor, where we turn market madness into your money-making edge. I'm your name, and today, we're diving into the chaos that just rocked Wall Street. The $1 trillion market wipeout on November 13th, 2025. That's right, poof. $1 trillion vanished in one day, the worst drop in over a month. Dow plunged 798 points, S&P 500 down 1.66%, Nasdaq hammered by 2.29%. If your portfolio felt that sting, you're not alone. But why did this happen? Is it the start of a bigger crash? And what's brewing for November 14th and beyond? Stick around, I'll break it down, share recovery tips, and reveal what smart investors like you should do next. If you're new here, smash that subscribe button and hit the bell. We're all about building wealth strategically. Let's jump in. China's economy is flashing red lights. Weak data showed slowing growth, impacting global trade and U.S. companies with exposure there. Add in ongoing U.S.-China tensions like potential tariffs under Trump, and you've got a recipe for uncertainty. It's like the world's second largest economy catching a cold and the US sneezing in response. Bonus factor: spotty economic data ahead. Traders braced for volatility, and boy, did it deliver. This drop wiped out weeks of gains, reminding us markets climb stairs up but take the elevator down. Fast forward to today, November 14th, the pain isn't over. Futures are pointing lower, Dow down about 0.5%, S&P slipping 0.6%, Nasdaq futures off 0.5%. Uncertainty lingers on that Fed cut, with traders split. If rates stay high, expect more pressure. But hey, Bitcoin's dipping below $100,000 to crypto feeling the heat. As a strategic investor, this is prime time to watch for bargains. So, is this the big crash? History says no bull markets end, but dips like this often rebound. Predictions for late 2025? Healthy gains overall, but volatility from Trump policies, Fed decisions, and global shifts. The IMF warns of overvalued U.S. stocks worse than the 1930s or 2000 bubble, so diversification is key. Pro tips from legends like Warren Buffett: 1. Be greedy when others are fearful. Buy quality on dips. To diversify beyond tech, look at emerging markets outperforming. $3 cost average. Don't try to time the bottom. If you're prepping for more turbulence, build cash reserves and hedge with bonds. My take: this could be a buying opportunity if you're long-term. But watch Nvidia earnings and Fed signals, they'll dictate the rebound. That's the scoop on the $1 trillion wipeout. Strategic investors. Markets are wild, but with the right strategy, you win. What do you think? Is this a dip or the start of something bigger? Drop your thoughts in the comments, like if this helped, and subscribe for more breakdowns. Check out my last video on related topic for more tips. Thanks for watching, stay strategic, and I'll see you in the next one. It's November 13th. Markets open strong after weeks of record highs, but by close, total bloodbath. The Dow Jones Industrial Average shed nearly 800 points, that's a 1.7% nosedive. The S&P 500? Down 1.7%, erasing recent gains, and the tech-heavy Nasdaq? Ouch, to 0.3% gone, led by AI darlings like Nvidia tumbling hard. It's like the market was on a sugar high from post-election optimism, then crashed harder than a kid after Halloween candy. Why the fear? Investors are spooked. Volatility spiked as traders dumped shares, especially in big tech. This wasn't just a US thing. Global markets followed suit, with echoes of weakness from China rippling worldwide. Think of it as a domino effect. One big tech stock wobbles and the whole tower shakes. And check this out, Nvidia, the AI kingpin, got slammed. Shares dropped amid broader tech rotation. If you've been riding the AI wave, this might feel like a gut punch. Now, let's unpack the why, because as strategic investors, we don't panic, we analyze. First up, the tech sell-off intensified. Wall Street's been buzzing about AI, But with Nvidia earnings looming next week, doubts crept in. Are we in an AI bubble? Traders think so, selling off mega caps like they're hot potatoes. It's like that friend who overhypes a party. Eventually, reality hits, and everyone heads for the door. Fading hopes for a Federal Reserve rate cut in December. Inflation data came in hotter than expected, and traders dialed back bets on lower rates. Remember, lower rates are like free money for stocks. They fuel borrowing and growth. But if the Fed holds steady, growth slows, stocks suffer. Here's a quick look at Fed predictions.